What if the most honest financial advisor in the world wasn't a person, but the ocean itself? We spend trillions on high-speed computers and AI algorithms to predict the next market crash, yet the most accurate signal might be hidden on the deck of a 200,000-ton rusty bulk carrier ship. It's a paradox. We look for economic truth in complex digital noise, while the real answer is written in the simple, physical movement of steel, grain, and coal across the sea. You think you're watching the financial markets, but are you watching the one indicator that cannot lie?
This is Finance Beyond Seas. We explore the moments where the currents of maritime history and the tides of the global economy collide. We're here to navigate the wreckage of the past, to find the financial lessons that will protect you today. We analyze history and systems, not futures. Nothing presented here is financial advice. It is purely historical and economic commentary.
Long before computers, the original economic forecasters weren't bankers. They were maritime publics. The most powerful of these was Venice. In the 14th and 15th centuries, Venice was the Wall Street of its day. But its power didn't come from stocks. It came from Mude, or state-sponsored shipping convoys. The Venetian government organized, protected, and auctioned off the rights to use these galleys, which sailed in precise, scheduled routes to Constantinople, Alexandria, and Northern Europe. Here is where the smart money of the era was revealed. The real economic indicator wasn't the price of spices or silk in the market. It was the price paid at the Mude auction. If merchants bid aggressively, paying a high price to lease cargo space on the Flanders galley, the Venetian Senate knew that demand for English wool and Flemish textiles was high. It meant Northern Europe was prosperous. If bids for the Alexandria galley were low, it signaled that the Mamluk Sultanate was in turmoil, or that demand for Eastern spices was drying up. The Venetians didn't need complex charts. They read their entire economy by watching the demand for space on their ships. One famous example was the financial crisis following the War of Chioggia against their rival Genoa in the late 14th century. Venice was nearly bankrupt. How did they know they were recovering? Not by political speeches. They knew recovery was real when the Mude auctions began selling out again. The demand for shipping returned before the city's coffers were full. The ships were the leading indicator. The micro lesson from Venice is clear. The price to move goods is often more revealing than the price of the goods themselves. But it wasn't just governments who understood this. Fast forward to 17th century London. The new center of global finance wasn't a palace. It was a coffee shop. In a small establishment run by Edward Lloyd, an entirely new financial system was born. This wasn't a bank or a stock exchange. It was a meeting place for ship captains, merchants, and wealthy individuals willing to take a risk. This, of course, became Lloyd's of London, the most famous insurance market in the world. To underwrite or insure a ship's voyage, these men needed real-time, unbiased information. Was the ship sound? Was the captain reliable? Were there pirates off the coast of Barbados?
The price they set for that insurance premium became one of the world's most powerful economic indicators. If premiums for voyages to the Caribbean suddenly spiked, it told you more than just that the weather was bad. It might mean a war had broken out, or that the sugar trade was so profitable that ships were overloaded and sinking. Like the Venetian Mude, the Lloyd's insurance premium was a hard-to-fake signal. It connected the physical risk of the sea to a real financial price. The theme is the same. To understand the real economy, look at the price of movement. This need for a single, honest number became critical in the 20th century. After World War II, the world rebuilt itself. This wasn't a luxury goods boom like Venice's. It was a raw materials boom. Massive new ships, called bulk carriers, were built to move the fundamental building blocks of modern life. Iron ore for skyscrapers, coal for power plants, and grain to feed booming populations. In the 1970s and 80s, the global economy experienced violent shocks, particularly the OPEC oil crises. It became clear that the cost of energy and the cost of shipping were inextricably linked. This volatility created the need for a standardized benchmark. Traders, producers, and economists needed a single, reliable price for global shipping, free from government manipulation or speculation. In 1985, based out of London's Baltic Exchange, the Baltic Freight Index was born. It was the modern evolution of the lesson Venice and Lloyd's had already learned. The real pulse of the economy is the real cost of shipping. Fast forward to today, and that index is now known as the Baltic Dry Index, or BDI. The BDI is beautifully simple. It measures the daily average price to hire a dry bulk ship on 20-plus different global routes. It doesn't track oil tankers or the container ships bringing you iPhones. It tracks the giant vessels moving raw materials. This is what makes it the indicator that cannot lie. Why? First, you cannot speculate on the BDI. You can't buy paper BDI. A ship is either hired to move iron ore from Brazil to China, or it is not. It is pure, unadulterated, real-world supply and demand. Second, it is a leading indicator. The stock market is a lagging indicator. It reflects profits and sentiment about things that have already happened. The BDI reflects things that are about to happen. A company must hire a ship today to build a factory 6 months from now, or to manufacture a car 9 months from now. The most famous example? The 2008 financial crisis.
Stock markets, like the S&P 500, peaked in October 2007. The party on Wall Street was still going, but the BDI had peaked 5 months earlier, in May 2007. While the financial news was still positive, the BDI began to crash, falling an astronomical 94% before the collapse of Lehman Brothers. The sea knew. The factories had stopped ordering raw materials months before the financial system imploded. The pattern is clear. We saw it again in the 2020 pandemic. The BDI collapsed as the world locked down, then exploded in 2021, predicting the inflation and supply chain chaos long before it hit the headlines. What does this mean for you? It means that many people are navigating their financial lives using the wrong map. You are watching the news, which reports on the story of the economy, but the BDI reports on the physics of the economy. The risk is being blindsided. By the time your favorite news anchor announces a surprise recession, the BDI has likely been signaling it for half a year. By the time analysts celebrate a booming market, the BDI may already be showing that the foundation, the movement of raw materials, is crumbling. The cost of being unprepared is devastating. It means making decisions based on yesterday's information. It's like setting sail just as the barometer plunges. You might buy into a market at its absolute peak, right when the real demand has already vanished. Or you might panic sell during a crash, just as the BDI quietly signals that the real economy is picking up steam again. You are being influenced by sentiment, while the smart money, like the Venetians, is watching the ships. So how do you protect yourself? This is not financial advice. This is a call to adopt a new framework for thinking, based on the lessons of history. First, learn the lesson from Venice. Diversify your routes. The Venetians never relied on a single trade route. They had galleys for the Black Sea, for England, and for Egypt. In your own life, this means avoiding total concentration. History has shown that resilience comes from not having all your assets in one port, whether that's a single stock, a single industry, or even a single currency.
Second, learn the lesson from Lloyd's. Value the tangible. The insurers at Lloyd's built their fortunes on physical assets, ships and cargo. In a world of digital abstraction, it is wise to understand and appreciate things with tangible, real-world value. Historically, this has included hard assets, land, or commodities, but the ultimate tangible asset is your own skill. Can you build, fix, or create something of value? Third, learn the lesson of the BDI. Develop uncommon sense. Instead of just following the crowd, look for the unsignal, the data that can't be faked. The BDI is one, but there are others. What is the price of energy? What is the demand for skilled labor? What are the inventory levels at local stores? You don't need a PhD in economics. You just need to open your eyes and watch the real world, not just the screen. The global economy is not an algorithm. It is a vast physical machine. It is a network of mines, farms, factories, and the ships that connect them. At Finance Beyond Seas, we believe that the screen will always try to tell you a story, but the sea will always tell you the truth. The lessons of the past are not forgotten. They're simply written in new languages. The pulse of the global economy is the pulse of the ocean. You don't have to be fooled by the noise of Wall Street. You have the power to look past the charts and instead learn to watch the ships. Understand the system, and you will no longer be a victim of it. What's the realest economic indicator you personally watch? Let us know in the comments. If you'll never look at a cargo ship the same way again, subscribe to Finance Beyond Seas. Join us as we continue to navigate the currents where the real economy and financial history collide.